Now, to address that question, we need to have a framework in terms of establishing where we are in terms of economic cycle. So from a growth perspective, we believe that we are seeing signs in terms of contraction as well as a slowdown. Labour market is cooling down, we're seeing disinflationary pressures emerging, as well as corporate profitability moderating. So from our perspective, we are firmly in this late cycle environment, which typically is conducive for high quality and duration sensitive asset classes. And it's also the reason why the Fed has been cutting, because no longer is there concern in terms of inflation. Now it's a concern in terms of growth and how the labour market is to react. So we believe in this backdrop where growth is moderating, inflation becoming disinflationary, and the reaction function of central banks easing, this is very much a conducive background towards the bond market. We see ample opportunities across the globe, but from a regional perspective, we have a preference for Europe over the US. One, because of valuations. We believe that European credit is pricing in more of a recession type risk compared to maybe US credit. But also more importantly, from a credit cycle perspective, we do see Europe as exhibiting less late cycle behavior compared to the US, given that it's more bondholder friendly in nature compared to the US, which are more shareholder friendly in terms of activity. Sector perspective, we do prefer banks, but not all banks. We do have a preference for European and UK banks, simply because valuations, especially down the capital structure in subordinated debt, is offering value, especially compared to, say, US regional banks, where we think that the level of capitalization is quite low. Now, also from a sector perspective, we do prefer energy as a sector. We believe that given the geopolitical risk that we're seeing in terms of the Middle East, energy price shocks would favour those countries which benefit from energy price vol, and this is mainly in terms of the energy sector. Looking at the valuations of the asset class, we do find that yield is attractive. In fact, it's the most attractive it's been since the global financial crisis. Now, whilst we wouldn't go as far to say that it's once in a lifetime opportunity, like the GFC, we do think that there's a once in a generation opportunity to get involved in this asset class, simply because income is actually quite an attractive proposition. Even if nothing moves, we're riding on a significantly attractive yield in the portfolio. In terms of the risk that we potentially might see on the horizon, which might impact the asset class, we see three potential risk factors. One is in terms of like increased volatility, maybe from geopolitical risk. Two, potentially under election of either candidates, we could see an increase in terms of fiscal stimulus, which might see higher issuance needs from a treasury perspective, which might see long end pressure in terms of like yield steepness. And thirdly, it's all about the labour markets. If it potentially cool downs more than it's supposed to, then in which case we might see hard landing risk materialise over the base case of a soft landing scenario.